Technical analysis made easy, a starting place for new traders. Trend analysis. When buying anything of value, whether tickets to a sporting event, a new car, or even a house, you want to know if pricing on that item is going up or down. This helps you to decide whether to buy that item now if prices are increasing, or later if you think you can get it for less. The same is true in trading, and we call this trend analysis. Let's see what tools we can use to identify the trend. Identifying trend. The trend is the general direction that a market is moving over time. Ideally, a trader can take advantage of the observed trend to make successful trades. Understanding what the current trend is, and if that trend is changing, can help you participate in the market in an informed way. In this video, we will focus on 3 different tools that can help you identify trends and their strength. Trend lines. The easiest way to identify a trend is to simply look at the chart. Using a trend line, you can connect data points to get a sense of what a trend looks like now and where it could possibly go if the trend continues. In an uptrend, connecting pivot lows help to identify a support line. When broken, the support line indicates a possibility that the trend is changing. In a downtrend, connecting pivot highs identify resistance. A break above this line could indicate that the downtrend could be reversing. You can use a horizontal line to identify where there is support or resistance in a sideways trend. In this case, a break above or below the horizontal line might indicate an uptrend or downtrend is forming. Moving averages. The most common indicator in technical analysis is the moving average. The moving average smooths the data such that an overall trend is easy to see, especially in markets where there is a lot of chop or churn. The moving average achieves this by taking an average of the latest n periods on the chart. It is considered moving because as a new data point is tallied, the oldest data point falls out of the calculation. Common durations for the moving average on daily charts are 50, 100, and 200. Intraday charts tend to use smaller average periods. There are a few different ways to calculate the moving average. The most used is the simple moving average. The average calculation is found by adding up the last n closes and dividing by n. The exponential moving average uses a calculation that gives greater weight to the most current data points. Other moving averages types include weighted, which also places more importance on the most recent data points, and triangular, which applies the simple moving average formula to the data twice. The moving average can be used in several ways, identifying trend as support and resistance, and to identify trend change. The moving average shows what the overall trend is when it may be difficult to discern just by looking at price. Even though a moving average is not a straight line, it can be used to identify possible support or resistance, like trend lines. As price nears the moving average from above, the MA acts as support, with the expectation that price might have difficulty continuing through the moving average. Likewise, as price approaches a moving average from below, the moving average can act as resistance. Price crossing through a moving average can indicate that a trend is changing. When price crosses above a moving average, that is bullish indication. Price crossing below is a bearish indication. You can also use the crossing of 2 moving averages to identify trend change. When the shorter-term moving average crosses above the longer-term, a bullish trend is possible. A bearish trend is indicated by a shorter-term crossing below the longer-term moving average. Trend direction and strength. The DMI and ADX indicators are used to determine trend direction, DMI, and trend strength, ADX. The directional movement indicator, DMI, compares the change in highs and lows from bar to bar to determine whether a bar's move is more positive or negative. This results in 2 lines, the DI plus and DI minus lines, usually shown as green and red lines. The interpretation is such that if the DI plus line is greater than the DI minus line, the trend is bullish. A bearish trend is indicated by the DI minus line being above the DI plus line. When the two lines cross, a trend change could be in play. The average directional index, ADX, is a derivative of the DMI and is used to measure trend strength. A value of 25 or below indicates no trend, while values above 25 indicate a trend is in place. The higher the value above 25, the stronger the trend. While understanding trend gives you a solid foundation when analyzing markets, there are many other ways to interpret price action. In the next video, we discuss the most common momentum indicators used by traders and analysts. Thank you for watching.